Of course, we want to know how this lesson pertains to how trading opportunities will present themselves using the average true range indicator. And as we mentioned, the average true range is useful to get a feel for potential trading price ranges. And what will happen is occasionally we will see the market take price and push it well beyond the average true range as indicated by our ATR indicator. And we're going to look for opportunities to trade a retracement when price is pushed to an extreme. These trades are higher in risk, but they can be some very, very, very good trades. And I do make quite a few of these trades on a percentage basis. Some of the criteria that we want to look at, and I have a list of criteria here. I do not want to hear from anyone that you have attempted to make a trade like this and that all of the criteria has not been met. Now, there will be times when you get experience with these kinds of trades that one or two of the criteria may not be met, and you can still make the trade and make it effectively. But also on the other end of the continuum, all of the criteria may be met and you may still lose. That's trading. First of all, price must push at least 25%, preferably closer to 50%, beyond the average true range intraday. It is preferred if price has moved with good speed, and particularly noticeably good speed toward the end, and starts to really, really slow. So it travels with good speed, lack of liquidity. As it gets towards its key level, starts to slow and become weak and show weakness. Price must be at a significant level of resistance or support that is unlikely to be penetrated to consider the counter move trade. What that means is that you are going to analyze the market. You're going to identify clear levels of support or resistance, and if price has stretched to 25 to 50% beyond average true range, you're going to watch that level of support or resistance as the area where you want to make the trade. These types of trades are preferably made later in a session when liquidity begins to dry up and traders start to go home, because as liquidity begins to dry up, then price is typically less likely to make new highs or break new levels beyond significant or key levels that you've identified in the market. They're less likely to break later in the session when liquidity is thinner. This type of trade absolutely works best using the pound dollar, as it trades in larger ranges, and so the moves and the response to certain key levels is also much larger. You really may want to consider only focusing on the pound dollar for this one, and as many of you know, the pound dollar cross can be a tough one to trade unless you really understand it well. It is also, as a general rule, and I've mentioned this in the past, and as a general rule, it's less likely that the market will move to new levels, new highs or new lows during the Asian session following a large move that has been generated during Europe and North America. So if price has moved, if the pound dollar has moved up, say 240 pips during Europe and New York session, it is typically less likely to move even higher during the Asian session. Often the Asian session will come up and retest the highs that were generated during Europe and New York, but is typically less likely to fail to continue to make new highs. Here's an example. We have this consolidation. Price moves from this low, the intraday low of 8,700, the figure. It rallies 240 pips intraday, and then it stops at the 10-day moving average, and what you want to look for is you want to look for a key level that goes back in time as well, that converges with this 10-day moving average. Price stalls and then starts to retrace as the Asian session starts. Then when London opens the next day, we rally, form a tweezer top, and fall. But it's really the intraday move that we're looking at that we want to sell. Usually on the British pound, this will fall even more once it's achieved this high. But in this case, traders just went home and left price trading and consolidating at a higher level. On this day, the average true range was 165 pips for the British pound, but it actually moved 240 pips, which is well beyond max range plus 25%. You see the red line here and the green lines. This is S1 and S2. The red line is essential pivot, R1, R2. These types of trades will pretty well always be beyond the range as identified by the pivot. For example, R2 and S1 will almost always move beyond this range. That's just the way the numbers work. I mean, it's the math that if you have average true range plus 25 to 50%, you're going to be beyond these key intraday ranges as defined by the pivot levels. Looking at an example here now. You see this long candlestick right here that goes from 7,600, the figure. Are you seeing some patterns here now with the figure? We're going to cover that lesson after this. 7,600, the figure, price rallies. I was looking at 7,800 to sell. It had an intraday move of 170 to 200 pips. And I was disturbed by this because we had this 10-day moving average, and you see this previous high over here, 7,800. I wanted to see price move all the way up to 7,800 so I could sell it on this particular day. But this was a Friday, and it didn't get there on the Friday, and I thought that's fine. This is a bit of an exceptional case, but that's trading. Trading is always going to be an exceptional case. It's always going to be a unique case. It's always going to be a unique environment. It's not going to be exactly as we've presented here in these lessons, nor is it going to be exactly like the preconceived ideas that you have as to how the trade is going to come to fruition. You have to work with the market. Now we have this Sunday period, and then on Monday what happens is traders move it up. In Asian session, traders move it right up to just about 7,800 and this previous high. And again, the 10-day moving average is pushing on it, putting pressure on it. I'm sorry, this is the 200-day moving average. I apologize. The 200-day moving average. I'm just accustomed to looking at the smaller time frames, but the 200-day moving average is pushing on it, which is important. As price typically respects the 200-day moving average, since there are a lot of participants looking at the 200-day moving average, as we see back here in time, this beautiful weakness in tweezer pushing on the 200-day moving average, and we see the move that followed, 1,000 pips. So we have very good reason to suspect or anticipate that price will move down from this point. Now let's look at it a little bit closer. Our average true range on that day was 130 pips on January the 13th, and we're seeing there's a slight MACD divergence here, but we won't pay attention to that too much. Let's take a closer look. I just want to show you. You see this view here. Let's take a closer look. Here's a previous resistance at 17800. This is a 4-hour chart. So we've broken it down to magnify our view. Price has fallen. It is retraced. And look at, you see how we see this nice move up, and then price is getting slower and choppier and less willing to make new highs. Here's our big intraday high from 7,700. Sorry, from 7,600 to 7,800, and this is where we saw price move too low for an entry, because I was waiting. I actually had a sell order at 7,800, but it didn't take me in. I waited for the weekend to pass, and then price made a go at 7,800. And look on this 4-hour, this real nice doji here. Failed to move past resistance, and then proceeded to fall. But what we want to do now is we want to look at it on a 1-hour time frame, and before we go down there, we'll see this divergence here on the 4-hour. But now we want to look at it on a smaller time frame. Looking at the British pound 1-hour time frame here, we just want to spread it out a little bit, and we see this low here. Price has rallied. It has retraced 62% to 7,600, the figure. From the 62% retracement, price has rallied, struggled to get through the highs, rallied to the 127% extension, consolidated into from the Friday into the Monday. Then on the Monday, look how short a period of time it took to make an effort to get to 17800, and then it fell. Now normally I'd like to see all this happen in one day, the rally, the test, and the fall. But in this case, because it was a Friday, and this is a trade that I would make anyway on the Monday, but the true range, certainly it carried over, but clearly it also helped in analyzing this trade. Just to give you a summary here, we had the trade move 25% beyond maximum intraday range. On the 4-hour, we had an MACD divergence. Resistance was at the figure. Resistance was at the 200-day moving average, which is not in here. We had previous resistance, and we were also at 127% Fibonacci extension. Rules for trading the average true range. When you spot a currency making a large intraday move, go to your daily chart to determine what the average true range is for that day. Take the average true range and add 25 to 50% to the average true range to determine the approximate maximum average maximum intraday range. Take a view at the technicals to see what significant levels or support may be found in the max range area. So if you take your average true range, add 25 to 50%, closer to 50% is better. Look to see what significant levels you can identify on your charts. Determine if the significant level of resistance or support may be an area for a trade consideration, because it may not be an area for trade consideration. Don't just trade this thing when price is in no man's land. Don't do it. It has to be at a distinct level of support or resistance. On these types of trades, when I've identified my levels of support and resistance, I will put an order in, and the majority of the time I will say that my order will not get taken in because price did not meet my criteria. I do not have to be in the trade. I simply wait. If it takes me in the trade, then there's a very high probability I will make money on it. But if I trade that thing in the middle of nowhere, I am totally exposed and totally vulnerable to being stopped out. It's preferred if the trades are made during late New York or even Asian session. And the criteria should also be that if London opens up, then that should change your assessment as to whether or not you're still interested in being in that trade. The market is typically less willing to commit to new levels during these times. although the move may continue. That's trading. Try to make the trade during the first, I should say the first, or second attempt at the desired level of resistance and support. Don't go for the home run. Take at least 90% of your position out at 20 to 30 pips for profit. Leave 10% in just in case the balance becomes a significant turning point. It's a high risk trade against a strong move. These types of trades don't come along that often. You might see a few a month, and that's about it. And be careful out there.